2 months into the U.S. Iran war, the Strait of Hormuz remains effectively shut. That closure has halted 20% of the world's seaborne oil trade. The global stockpile initially looked enormous, holding roughly 8.4 billion barrels of oil at the start of 2026. But right now, the market is burning through those reserves at a record pace of 11 to 12 million barrels per day. That math points to a hard stop by early June. This is because the vast majority of those 8 billion barrels are physically locked inside pipelines and refinery tanks. They cannot be moved without destroying the system itself. When you only count the oil the world can actually use, the clock runs out in weeks. Relying on total global inventory numbers creates an illusion of plenty. It masks a physical supply collapse that the system is mathematically unable to avoid. The problem centers on operational stress. You cannot physically drain the world's infrastructure to zero. If you draw below minimum levels, pipelines lose flexibility, terminals seize up, and refineries lose the feedstock they need to function. This chart shows how that massive inventory actually breaks down. When you subtract the volumes permanently locked up as pipeline fill, required refinery stock, and minimum tank levels, the actual accessible supply is revealed. Out of 8.4 billion barrels, the world only has about 800 million barrels of usable buffer, and that buffer is disappearing. By late April, 35% of that small usable supply had already been consumed. Because over 90% of the world's oil on paper is functionally untouchable, the safety net is a mirage. The timeline to physical exhaustion is accelerating. The immediate and severe physical consequences of this global inventory math are already hitting the major economies across Asia. Countries like China, India, Japan, and South Korea absorb the bulk of Gulf crude. Because they have shorter supply chains and heavy reliance on the region, their usable buffers emptied weeks before those in Europe and the United States. The result is immediate economic damage. Factories are shutting down, governments are imposing fuel rationing, and places like India and Pakistan are dealing with severe power grid failures. The logistical networks are also failing. A lack of aviation fuel has forced the cancellation of more than 150,000 flights. Asia serves as the lead indicator for an infrastructure failure that is mathematically certain to hit the West next. When that usable buffer hits the operational floor in June, the global market will face a staggering mandate. It must instantaneously shed 11 million barrels of demand per day. This compares that requirement to the largest disruptions in history. The COVID-19 pandemic only reduced demand by 9 million barrels per day. The major energy shocks of 73, 79, and 2008 each removed no more than 5 million barrels per day. This time, there are no pandemic lockdowns to mandate conservation. The only mechanism left to destroy that much demand in a matter of weeks is astronomically high market pricing. The oil market is being forced to execute a demand drop larger than any in modern history, relying entirely on price signals. This stalemate is driven by a mutual chokehold. The U.S. naval blockade is strangling the Iranian economy, while Iranian military vessels maintaining control of the strait bleed the world's oil reserves dry. For now, the United States is temporarily protected by its own domestic crude production, but that protection is fragile. The macroeconomic crisis will arrive when global diesel shortages hit the logistics sector. Diesel powers the freight networks, meaning a shortage paralyzes manufacturing and halts the movement of basic goods. Stress tests show how severe this could get. Current models assign a high probability of crude reaching $200 a barrel, with worst-case scenarios pushing theoretical prices as high as $370. By the end of June, the math runs out. The world is about to find out if price alone can force a global economic shutdown faster than any government decree ever could.